Can I see anyone would like to be first with a question, please? Excellent. I spotted this gentleman in the front row. First of all, Dimitri will get a sprinting with the microphone. Excellent.
At the end of 2017, beginning of 2018, I came up against the problem of not being able to purchase a whole bunch of ETFs in the US market that I used to be able to on the TD Direct platform because of new European regulations that they have to have the KIID documents. And I'm just wondering whether II can do something or improve the situation so that I can use II to invest in things like the Alternative Harvest ETF.
Yeah, I'm sure we can. We'd love to. Richard, maybe that's one for you to answer. He wasn't going to come up on stage, but here he is.
I wonder there'll be questions on II or not. I thought I'd stand down. So we are subject to very specific regulation in terms of US ETFs versus UK domestic and who can invest in those. The short answer is no today, and we can't do that. That would be a breach of PRIIPs, and that's something that we can't do. There are obviously some investments which are onshore, if you like, which we can do, but unless you're a foreign resident, if you're a UK resident, we can't offer direct US ETFs. Simple as. I shall stay up here for a minute.
Great answer, thank you. There's a gentleman in the front row here who wants to ask something. There's a microphone just coming. There we go, thank you.
A question about investment trust discounts, but I also have a question nothing to do with investment trusts. So if you're allowing two questions, I'll ask the one about investment trust first. I only invest in one, which is JP Morgan Russia Investments. And I've just noticed that the discount is just widening, and now it's about 105. So it's 520 today, or 524 to buy a share in this investment trust. The valuation, underlying valuation is about 625. And I've just noticed that keeps on widening. It might be the fact that it's gone ex-div. But what determines the discount, and should we be alarmed about the discount varying?
I suppose I should probably answer that. Well, I mean, obviously it's the marketplace that determines the discount of an investment trust. I mean, I think in the case of Russia, our Russia fund, people are pretty pessimistic about Russia. So I think that I hope you've had a good experience over the long term owning the Russia fund. But you know, the discount is it's not something that the manager that we can control. I mean, obviously, as Tom was saying, the wider the discount, the greater the opportunity is for somebody to make money by that when that discount narrows. But it's not something that is controlled by us. It's purely driven by the market.
Yes, please. Okay.
This question is about how you value. I'm a high-risk investor, so I invest in AIM and loss-making companies that are in research and development stage, and are loss-making, and I don't know how to value them. If you've got a PE ratio, it's based on earnings. If it's not earning anything, and year after year it's making losses of 1 million, 2 million, then back to 1 million loss, and then up to 2 million loss. What is the best way to value that? Is it net asset value, which you can learn from the LSE site?
I think that's maybe one for our Richard Hunter to have a go at answering.
I wouldn't like to be looking at your portfolio at the moment. That certainly is high risk. I think net asset value is something you need to certainly have a look at. I'm assuming if they're AIM companies, it's unlikely, or that's possible, but unlikely they're paying a dividend. They're not, okay, what a surprise. Net cash in the bank, net asset value, and as a high risk investor, just keep asking yourself that question, which in one way or another we've all mentioned tonight. Would you still buy that share today? Yes. Or are you chasing losses, you know, in terms of the share price?
Yeah. Great answer. There's a chap over in the corner over there at the back. Keep your hand up. Right.
With the current increases in debt-funded share buybacks, what sort of level do interest rates need to reach for this to become unsustainable? And is it something that investors should be worried about in the short term?
Oh, that may be one for... Yeah, you want to take that? Yeah.
You're absolutely right. We're seeing an increasing prevalence of share buybacks pretty much across most markets, I would argue, certainly in Europe. And you make the very fair point that clearly we're in a very low interest rate environment, and so funding debt is much easier today than perhaps on average through the cycle. For us, from a European perspective, we don't see interest rates rising particularly aggressively in the short to medium term anyway, so I don't think this is a problem for today, tomorrow, next week, next month. It's something that we need to think about into the future. But we would essentially say that from a buyback perspective, you need to take that signal with much more of a pinch of salt anyway, because generally speaking, companies will buy back shares, yes, if they feel that their stock is undervalued, so it's a positive signal from that point of view, but they'll also commit to share buybacks more readily potentially than committing to an increase in their ordinary dividend levels. And the reason we see that a lot is that share buybacks are very easy to withdraw from the market without much of a negative signalling effect. So as investors, we give much less credence and credit to a share buyback than we would a dividend, because once a company commits to paying a dividend, it becomes much more difficult for them to reverse that. So almost think about buybacks as more of a tactical indicator of what a company's doing and how strong a company's balance sheet or cash flow looks like, but don't hang your hat on it as a signal that this company is going to continue to return capital to shareholders into perpetuity, or at least into the medium to long term, because to your point, if the cost of debt goes up, and that could be because of interest rate rises, or it could be because of the risk profile of the individual company, you can very quickly see that buyback disappear again. So it's not really answering your question exactly, but what I would say is that we wouldn't be too concerned actually to see these buybacks coming down because interest rate levels are rising. That effectively might actually force the hand of management teams to move to a higher quality way of returning capital, which is through dividends. So we'd actually be looking to see that in a rising rate environment.
Thank you very much. There's a lady in the middle there. I always like to give a question opportunity to a fellow lady. Thank you.
Thank you for organizing this event. Amazing ideas. One that I like in particular is about portfolio decluttering. So how about a fee-free day to help us achieve that?
Oh, good idea. Sorry, I shouldn't say that.
Spring cleaning.
A very good suggestion.
Yeah, we'll have a think about that. Yeah, it's not a bad idea. You can hear me anyway, can't you?
Yeah, I think
so it's a great idea. We'll ponder. We'll ponder.
Okay. There's another one. Gentleman in the second row here, who can get there first with the microphone. Great. Thank you.
Thank you. Thank you. As Europe's a fairly developed market, what's the advantage of having a European investment trust as opposed to a global investment trust? Because surely they're both looking at the same companies.
Sure. I think the first point that I would make is that clearly this is an investment trust that is geared around generating income and dividend yields for investors. And to that point, Europe is a very attractive market from a dividend yield perspective. So if, for example, you were to go to a global strategy, I mean, the US makes up about half of the global market, and suddenly you're diluting your nearly 4% dividend yield on the European market with a yield that's closer to 2% in the US market. So number one, I would say if you're searching for income, that's a good reason to look specifically at Europe. The second point that I would make is, I think, quite a pertinent point given what we've seen over the last couple of years, which is quite a material focus in the market on some of the big tech stocks out there. So Richard mentioned Alibaba in emerging markets, but if you think about the States, you've got the FANG stocks, the so-called FANG stocks, Facebook, Amazon, Netflix, Google. And you can end up by introducing those stocks into your benchmark or into your investment universe, having quite a material skew towards specific parts of the market and specific themes that maybe you don't want to be exposed to. So if you're an investor that actually is much more interested in some of the more traditional sectors, some of the high yielding sectors by nature of the way Europe is made up, you will find that certain people have a requirement to stay away from the States, for example, or to stay away from other emerging markets in some cases where perhaps risk tolerances aren't high enough. So I think Europe is quite unique in many ways, unique in that it has a high yield, unique in that it has a very low exposure to tech stocks, but all within a part of the risk market which is fairly manageable for a lot of investors.
Fabulous. Right, there's a gentleman, Lee's going somewhere. Excellent. The first gentleman's hand up was at the end down there, I'm afraid. I'm trying to be fair with this. We've got about 4 minutes left of the Q&A session, so if you want to get a question in.
Yeah, in terms of equity returns for this year, which market would you say presents the best opportunity and which presents the worst?
Well, that's a difficult question. We're all looking at Richard Hunter.
The worst, who knows? Some of this is going to depend on what your expected rate of return is. I mean, in the year today, even the beaten up UK FTSE 100 is up about 6%. The three main US indices, Dow Jones, NASDAQ, S&P 500, all having double-digit returns. I'm sure these guys are well on top of what their specialisations are also doing. So I think the concern perhaps is that whereas over the last couple of years we've seen something of a synchronised economic recovery, the question is now, who's going to start slowing down the most? I mean, even if you don't believe the figures that come out of China, that they're just trimming their GDP forecast to 6%, even if you take the cynical view that it's somewhere near, judging by companies on the ground, it could be near 3.5%, that's still a fairly good clip. And again, despite what we're seeing in the US in some of their economic numbers, there's no question that there's almost record low unemployment. We've had a couple of gang-busting non-farm payroll numbers over the last couple of months. And for all the bluster, the US is in a pretty good state. So at this moment in time, with the injection investment-wise we're being given by low interest rates and the historic injection we have had from various QE programs around the world, I'm not even sure it's a regional thing. Something that I'm used to is taking that bottom-up approach because I'm mainly exclusively looking at the UK. And if you can find a quality company with an obvious economic moat, as Buffett would say, then you can benchmark it how you like, against the FTSE 100, against the global index, against your own kind of returns. But to pick out one dog of a country might be a bit dangerous at this point.
Okay, any more questions? So gentleman in the middle, just over there, come to you next.
Thank you. Can the euro survive? Because everyone is talking about, because there's a lot of different countries growing at different rates, some in debt, some in surplus. So
okay.
Can it survive?
One for you again.
Am I taking this? We think it can. This isn't necessarily a new issue. It's an issue that certainly has existed for some time. If you compare, for example, the strength of the German economy to some of the volatility that we've seen in the peripheral economies like Italy and Spain, for example. It's a challenge. I think the ECB clearly has a difficult job versus, for example, the Fed, who have one country to worry about. I actually think the fact that we got through the financial crisis, we got through the Eurozone debt crisis, and the euro has remained intact is a positive. And I think you know, where we are today in an environment where actually we see, notwithstanding the amount of political risk that clearly exists in the European market, we actually see things as being relatively stable, and I guess the main outlier is Italy and the debt situation in Italy, which they seem to be sensibly controlling from a government perspective. You know, I think we've been through worse situations than we're in today, and the euro survived. So we remain confident that it can continue to do so, but you need governments to act sensibly in terms of what they're doing on the debt side, and you need the ECB to continue to govern strongly from a central bank perspective. But they've proven to be able to do that in the past. We don't see any reason why they can't in the future.
Brilliant. There's a chap there in the blue.
I've got a couple of questions for Richard on the Emerging Markets Trust. First of all, you mentioned the returns from the Argentinian investment. Do you do any currency hedging, or was that return in pesos or in sterling?
No. We don't hedge currencies ever. This is a US listed company, so it's an Argentine-based company, but it's listed in the US. It's in dollars, so no, we don't have.
Do you take any local currency risk for countries like Argentina?
No.
Right.
The only companies that we invest in Argentina are companies that have a US listing primarily.
Okay. And then the other question is, I'm in the JP Morgan, invested in the JP Morgan Emerging Markets Open-Ended Fund. What are the differences in the way that, apart from the structural differences, do you take a different approach to managing the open-ended fund versus the investment trust?
The open-ended fund needs to have greater liquidity, so it tends to have a larger cap bias. One of the advantages of an investment trust structure is that you can own small, even very small companies. So that's the primary difference. So you find about 10% of the investment trust is in things that I would call small companies, whereas the open-ended vehicle would have very little in small companies and would have a much bigger market cap bias.
Now, we are running out of time. We have one question in the front row here. This gentleman's put his hand up a few times. Nina's just bringing the microphone over.
Thank you. Tangentially related to investment, given that the rise of populist parties seems to be driven by the people beginning to realise that the status quo and the way things have always been done isn't working for them, why is there such a fear of the election of a populist party?
Good question. I think I agree with your point that there is a broad-based recognition that the status quo is not working. What I don't think you necessarily need to resolve that problem is populist parties that have relatively extreme views either to the right or to the left, depending on what country you look at and what party you talk about. And what I think is a very interesting development, to use an example, most recently in the UK, is the emergence of the independent group that we've seen coming out of, you know, a splinter of the Labour Party, and then more recently joined by a splintering of a few members of the Conservative Party. Now, that movement is also challenging the status quo, but it's doing so in a much more central manner. And I think actually that's quite important to think about, because if I look at why politics isn't working particularly well within Europe based on the status quo, it seems to me that the reason for that is because parties which have historically had centre-left or centre-right leanings have started to move to either extreme. And I don't think you solve that by bringing a party that's potentially even more to the extreme one way or another. I think you solve that by trying to create more of this central option, which is seemingly becoming much harder to come by, regardless of which country you look at across Europe. So for me, I'm watching with interest how this independent group in the UK develops, whether it continues to grow or whether it turns out to be more of a gimmick that fails to actually change anything. I think if the former happens, we could be experiencing very interesting times, particularly in the UK, and that could be a precursor to potentially similar things happening elsewhere across Europe.
Fabulous. Well, I'm really sorry, but I'm going to have to pause it there. Thank you very much for all your fascinating questions. Thank you to the speakers for their Really, really amazing presentations. Thank you to JP Morgan Asset Management for hosting us in this amazing building. And please come downstairs where you can all have a drink, and there's some nice other refreshments being put on for us. So thank you for coming to Fight Club.